Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. This is host Richard Bernoulli. Today we have Mike Every and Ira Harris. It's Monday, May 22nd in the Western Hemisphere and Tuesday, May 23rd in Singapore, where Michael, our guest, is based. He's global strategist at Rabobank Singapore, where he analyzes major developments and key thematic trends. His research is frequently quoted in financial media, and he's a regular conference keynote speaker. He joined Rabobank in 2013, and he's been in the research field for almost 25 years, based in many different locations. Ira's the independent trader, hedge fund manager, global macro consultant trading foreign currencies, equities, bonds, and commodities for over 40 years. He was also CME director from 1997 to 2003, and a stint most recently. Welcome, gentlemen.
Thank you very much.
Thank you yet again, Richard, for your good offices.
Great. I thought we'd begin, Michael, with your global macro view on the economy, global economy, and financial markets.
Well, as a global macro overview, our house view is that things are not too good, but not as bad as some people fear they are. We do think the greater likelihood than not is that we're heading for a technical recession ahead in the US. That said, Europe appears to have avoided the worst of it so far. We think things are slowing down a bit there too, and we're not saying by any means that things are looking wonderful, but they're not looking absolute doom and gloom. But obviously, you don't have to really have any kind of peripheral vision to see risks on the horizon. Given the lag in terms of the interest rate hikes we've seen so far, the fact that the ECB are abundantly clear they haven't finished yet, and the Fed are hinting that they've got more to do. Frankly, there is more pain to come. It's just a question of recognizing where that hits and when. But that doesn't mean that we're looking at a new 2008 repeat or that we're looking at the GFC. We can certainly see significant pain in some sectors. But I think when you take the overall macro or geopolitical macro view that I do, it's a much more nuanced picture. Yep, losers ahead for sure, but also winners.
Interesting. And your thoughts, Ira?
Well, that's exactly where I go and how I go. But, I respectfully to Mike, I mean, he sees a lot more, and Rabobank has been such a big player in the global commodity market, which on these podcasts we focus a lot on because there's a lot of investable opportunities that stem from there. And I'm not asking Mike for those, but just to give the broad picture, because that's what we deal with. We're not. I've read some of your work in order to prepare for this, so I see where you're going. It's a very comfortable fit because we're not bottom-up stock proponents. We look at the global macro picture and go, well, these are kind of obvious picks. I can go back to 2020, 2021 with Louis Gavay. We've done 3 or 4 since then, and through that view, we were able to really buy the mining companies. Not that we singled out. We did talk about ones because we didn't talk about indexes, but the shift in the global economy with the depressed certain sectors just provided some value. So like today, I mean, you're in Singapore. There was a very interesting piece put out today. I don't know whether you read him, Adam Tooze. You read Adam Tooze?
Oh, religiously. He's a wonderful thinker, brilliant historian.
100%. He's a little too tied into the FT lately, so I don't read him like I did. But I have the same sense that you do. He is a great global macro thinker and historian. Well, he published a piece today about the global auto market and that China is now the #1 exporter of autos. So, in that vein, you have to stop and think about that. who thinks about, you think about the domestic market in China, but I'm not necessarily concentrating on their export orientation. But then I think about it, and then it follows upon who's the second, of course, Korea and Japan. So it's all in your neck of the woods. And to me, so in the way that I would approach it, I'm looking at currency valuations. And the Japanese, who are I think were the second, and the Koreans were the third, but then you go back and you cross-check the currency valuations, those three countries have weakened currencies and are really going after, especially the European hold on the global auto market. So things like that, I think, are phenomenally important. And I'm with you on Adam too. So.
What are your thoughts there, Michael, in terms of what's happening in Asia, particularly with China, Japan, and the whole Yellow Crescent?
Okay, I haven't heard it called that before. What's happening in Asia? Well, look, first of all, Asia is a very, very varied place. It's kind of like saying, what do you think of European food? What are we talking about? A smorgasbord or pita bread? These are very, very different things.
Yeah.
Let's start with China, because I think we have to start there. The Chinese economy is in tremendous trouble. Tremendous trouble. Now, is it doing some things right? Absolutely it is. The economic model they use, which by the way is not their economic model, they haven't patented it. Japan and South Korea used it before they did. Brazil used it in the 70s, and it was a US economic model before it was anybody's. Germany's also dabbled with it in the past too. So the Chinese quote unquote economic model delivers brilliant export performance. It delivers overinvestment in anything that moves and anything that doesn't. It doesn't deliver consumer-based economies, which is what they need to shift to now. It's what they keep saying. They can't. They're structurally stuck in over-investing and, as I was just alluding to, over-exporting in a world which doesn't want to buy them. Now, right now they are, because China's leading on EVs, but everyone's buying them with gritted teeth and saying, well, we're going to set up our own supply chains. We're going to develop our own domestic industry. That's what Biden's doing with the Inflation Reduction Act. That's what Europe's talking about doing. That's what Japan's talking about doing. Anyone who's anyone is going to be doing it, which is a thesis of mine for a long time now. So China, is reliant on these exports, can't manage to stimulate domestically. They are in a liquidity trap. They've cut interest rates incredibly low, but because government debt is higher than Greece and rising, the fiscal deficit is worse than Greece's was at the peak of their crisis, if you actually account for it properly. And that's during reasonable economic growth this year. Household debt and some metrics is higher than the US. And corporate debt, I think, is either number 2 in the world or number 3. It's staggeringly high. There isn't a sector that isn't drowning in debt. Nobody wants to borrow anymore. They need something to get them going. They can't export their way out, but they're going to try. But there's a finite limit to how much the rest of the world, which is so much smaller than them outside the West, can absorb. Nobody wants to borrow because debts are too high. The state may have to go back in again, at which point, the renminbi is going to go through the floor, which will generate even more protectionist impulses around the rest of the world. Or they need to restructure the economy towards that consumption. But guess what? A, that's very difficult to do for anyone in that position, anyone, not just China. But B, it's impossible to do if you're running a Marxist-Leninist economy, which is all about what they call productive capital, not fictitious, which is a key Marxist dichotomy, which I've been hammering home to my readers for a long time, being relatively well versed in what's considered to be the arcane arts of Marxism or Marxism-Leninism. That China thinks as Marx did, which is about producing stuff. You've got a services sector job, that's basically parasitic on the back of someone who's producing stuff.
Okay.
If you're producing asset bubbles, which is what the US specializes in, unfortunately, to too great a degree, that's pure parasitism on the top of parasitism. You're not actually adding anything of any value. And I think there is some genuine, muscle to that view, but they take it to a ridiculous extreme, whereas someone said of Korea a generation ago, it's got Arnold Schwarzenegger's torso on Woody Allen's legs. And
Okay.
they keep pumping up those steroids on the top half and not exercising the bottom half. And the whole thing will eventually get to the point where it can't walk. That's kind of where we are. That's just with China. Now I can go on to other countries, but I think maybe someone wants to jump in before I do.
So we're left with take the money and run, and I'll be back. So,
Yeah. And China is, to think geopolitically, walking around with a note saying, "I've got a gub."
okay, I'm in good company here. A well-versed Marxist. So let me, if I can, pick up for a minute, because your initial thoughts goes where, and we've actually done a podcast with Michael Pettis.
Fantastic thinker.
Yes. Like, so we're in that camp, and we discussed probably for half of that podcast, trying to move China to a more consumption-oriented economy. And would they be able to do it? Because they have all that capacity, as you talk about, which creates an overhang for the world. And it was okay because I think during COVID, we did see China move to be more consumption-based as much as they could, because at the initial onset of COVID, or I won't say the initial, but 9 months into it, the renminbi yuan actually went down to about 6.2, which flew in the face of standard thought process, which is, well, the world's going into a deflationary spiral because of COVID. The Chinese are going to do everything they can to protect their export markets, and the yuan would weaken. But lo and behold, that didn't happen. In fact, and that actually, when Louis Gavay and I talked in depth about that, it's why we were able to see from a macro top-down perspective to get into agricultural stocks and mining stocks, because something else was going on in the world, and that was highlighted in the Chinese currency. The playbook was not playing out.
Can I jump in there? Because that segues to a really interesting point, in that one of the messages that I've been hammering home publicly on my limited platform for a while is that is what's really important now. Whatever else we're looking at, whether it's the Fed hiking cycle, which is obviously crucial to everybody, whether it's those FX movements, whether it's what China can and can't do and isn't doing, and all the rest of the economies in Asia and the emerging world in general, or the news out of the G7 over the weekend, or even the war in Ukraine, all of it. The underlying meta crisis, as I was calling it in January 2022, before Adam Tooze came up with polycrisis and everyone started to use that instead. No resentment from my side whatsoever. But the underlying meta crisis that we've got really is, I think, fundamentally about the fact that the global architecture doesn't work. The Chinese economy as it's structured doesn't work. The US economy as it's currently structured doesn't work. We all know the European economy doesn't. Japan's getting its mojo back to a certain degree right now because of shifting geopolitical supply chains, and because they have such a dearth of young people that finally people are being a bit pickier and a bit more entrepreneurial about where they're going to go and work, rather than doing the same thing for 40 or 50 years and then retiring. But overall, the global system doesn't work and is fragmenting and cracking, and we see that. And one of the key things that runs through that particular argument, and the ones you were just alluding to, is that I think that fundamentally what we're seeing is countries like China in particular, obviously Russia, screaming and shouting, standing next to them, are talking about trying to set up alternative systems whilst not knowing quite how to do it. And one of the key arguments that runs through that is, are we going to see a shift away from the global dollar system, with this fictitious American capital constantly going into bubble after bubble, which I'm a big opponent of, by the way, and always have been through my entire career? Or are we going to see something that's commodity-based, China-focused, Russia-focused, emerging market-focused, which is quote unquote productive or real? Now, that's the broad way of painting it. But I think what's important is, when we're diving into that, to recognize, number one, the Chinese economy, by every metric other than overproduction of things that people don't need, if you look at their debt profile, if you look at their money supply compared to FX reserves or even gold or whatever you want to track it against, goodness me, there's something that isn't sustainable in any way, shape, or form. Vastly more so than the US, particularly given their demographic profile, which will have no one around to pay the debt by the end of this century. their population will be smaller than America's in the year 2100. If you look at the current demographic projection, which is staggering, the labor force will only be, a fraction of the size of what it is now. China isn't a sustainable base for that. And if you're going to have the likes of Russia and other commodity producers like Brazil saying, well, we'll put real commodities behind it, you get into a battle between the fiat dollar and the Fed and Fed funds, and people saying, well, let's trade these commodities and have them as the base of the global collateral pyramid rather than a US Treasury or some kind of financial instrument created out of nothing by a bank digitally, in dollars. At which point, what's the Fed going to do? And this has been my argument. Are they going to sit there and watch this financial hegemony blow up and the Pentagon be unfundable and everyone go home and say, well, we had a nice time running the world and milking it, but let's just retire into the night now and go and watch Netflix? No, they're going to raise rates. They're going to raise rates to the point which blows up the commodities complex. And when the only thing supporting the commodities complex is a Chinese bubble, which it is, and commodity producers buying and selling commodities to each other, what are Kazakhstan and Turkmenistan going to trade? Gas to each other? What's Russia going to trade with Turkmenistan? Gas? They're all going to eat gas now? It's not going to work. You need to have a consumption complex at the end of it, which is what Michael Pettis explained so brilliantly, which is the West. If we take our ball and go home, sure, we have high inflation for quite a long time. Sure, we need more productive investment. We do. Sure, we need less bubbles. But it's easier for us to do that than for a bunch of commodity producers to suddenly create a consumption economy between each other. And for China, which can't consume anymore if it wants to build a new trading complex, which is going to look a lot like the British Empire to an extent, but where it runs a trade surplus rather than a trade deficit. So the early empire rather than the late one. That's a much harder jigsaw puzzle to assemble. And it comes down to this simple point, and I'll shut up in 30 seconds.
No, keep going. This is
well, you can make all the conspiracy theory or very, very complex arguments you want about Bretton Woods 3 and a shift of commodities, and I see all of it. I really do, and I agree with it. But you put Fed funds at 6%, you see how well it does, and you notice that oil is going through the floor above and beyond any SPR shenanigans, despite the fact OPEC keeps saying they're cutting production. Keeps going through the floor. Other commodities, except for key green minerals, which again China has got a good supply chain of, which is producing and turning into EVs, which is selling to the rest of us. Everything where they haven't already kind of locked themselves into that supply chain, commodities are going down broadly. It's volatile. Now, if the Fed cuts rates to 0 again, which is what a lot of people think is going to happen, because that's been the status quo ante, yeah, then they'll go through the roof. Then we really have a discussion to be had about what do we have other than bubbles. But I don't think they will. I think we're going to be stuck with high rates for quite a long time, and a whole swathe of the economy, which frankly is based on bubkus, is going to really suddenly realize it needs to be based on something productive.
so.
Very interesting. Yeah.
Richard, may I jump in for a second?
Yeah, absolutely. Go ahead.
Sorry,
So
I went too long there. I apologize.
No.
Very
You
interesting.
set the discussion. So yeah, and that's Richard's job. So I know he's going to fire you in a minute, but
No.
I won't be the only one being fired in finance. So there you go.
but it takes us back to the speech at Brookings 3 weeks ago, right? By
Bingo.
Jake Sullivan, in which
Yeah.
he lays out the new industrial policy, which, I mean, when I first read it, and I said to the person who sent it to me, who was a Japanese specialist, and he said, "Did you see this?" I said, "No, I hadn't. I read it." And my first response was, "Well, this buries the Clinton neoliberal agenda of the Democratic Center. I mean, that's dead." And it says goodnight to Tom Friedman. So they slayed that, but it brought me back to, I'm much older than you are, Michael. So, but I'm glad to speak to somebody who's actually read Marx, as I spent the late 60s and 70s doing. So, I will really enjoy that. But it brings us back, actually, to me, when I read it, I said, wow, this sounds very much like John Kenneth Galbraith, The New Industrial State, in which you had a triumvirate of, well, 3 pillars to creating the new industrial state. But the only thing that was missing from Jake Sullivan's piece in my mind was no emphasis on education, because the education is going to have to be brought forward into that model to mean something, because you're not going to be able to make these dramatic shifts from being I'll go, probably you're going to nod your head. So we'll go from Kindleberger's hegemonic stability theory to a more regional oriented one with, if you want to play, you got to join this club, and we'll do the best we can to share, to cut the pie up amongst us, but we're not going to deliver the pie in a global basis where capitalists receive the brunt of it.
100% agree with everything you've said. First of all, on the education side, let's look at this analogy. I don't know if the US can deliver. You're absolutely correct. Historically, it's kept importing, skilled labor, and it may have to do that instead, which is obviously predatory. Every time I hear someone celebrating how wonderful immigration is, which, I'm the grandson of immigrants, so completely understand that. But every time someone says it's wonderful, look, we've got all these doctors, these trained doctors, it's like, which country did they come from that doesn't have doctors now? No one ever talks about that. Really, that's a big issue. People are leaving, other countries are doing without. Anyway, so the US may have to do that. If it can't, it will have a problem. I agree. But if you look back to the European experience, so, late 19th century, early 20th century, the British Army, which used to be a thing then, it isn't anymore, trust me. But when the British Army was a thing, they went into our working class schools and they said, working class boys have got rickets and bow legs and vitamin deficiency, and they haven't got any bones or muscle mass because they're starving. We need to have free milk given to the children every day in schools, otherwise we don't have an armed force. We're starting to get to that point in the US where everyone's obese or has got, some kind of mental stress because, someone said something about them they don't like on social media, and or they don't have the education required to be in an increasingly computerized military industrial complex. So if the Pentagon's going to have to start to get involved the way the Ministry of Defense did in the UK a century ago, that will start shifting things. And I just add one other thing very briefly, if I may. I'm being a bit of a big head here, and I apologize.
No, it's wonderful.
Yeah.
No, I love the references you're making. I just want to flag, for viewers, I did actually predict the Sullivan speech, and I don't mean just before he gave it, because I didn't know what he was going to say at Brookings. But back in 2016, I wrote a paper the beginning of the year called Thin Ice, which is still out there on the web, gathering dust somewhere, in which I said basically, look, as this year begins, just after a year of FX wars where everyone's trying to devalue, years after a failed recovery from a global financial crisis, which I saw coming, which others didn't, and which we'd never really recovered from, I said 2016 begins with the global neoliberal compact, if you will, looking like a sheet of ice or a glacier in front of us as far as the eye can see, and it's a mile wide and it's an inch deep, and I strongly suspect we're going to go through to the dark, deep water underneath. And what did we get? Brexit and Trump. And in 2017, I was talking about a return to mercantilism globally. And then later in the year, I said, we're now going to be in a Cold War between the US and China, because that Chinese growth model we were both correctly describing to each other is going to see the US mirror it, because you can't fight mercantilism with free trade. What am I going to do? I'm going to subsidize my exports and sell below cost price and drive all of your companies out of business until I control the whole supply chain upstream to downstream, and then I'm going to raise prices. What are you going to do? Cut taxes for the rich and get everyone to go and spend stuff on your products. Ha! Yeah, that's the genius strategy being sold to America for a whole generation, which has got you in the mess you're in now. And now it's gone because Trump already rejected it and it ain't coming back from the Republicans. Sullivan and Biden have now put a nail in it for the Democrats. But what I find interesting, Ira and Richard, is this. If you could read the historical runes, having read the kind of people that you and I are talking about, this was always clear it would eventually happen. Eventually. Do you know how many mainstream economists in markets, in financial, financial research centers are talking about this? Thank you, Ira. Zero. None of this is happening. Right. I mean, I was writing about Sullivan when he said it, and I shared it with everyone. I shared it with my team. I shared it, and my team do understand this, by the way, because they have me shouting at them. But every other bank Sorry, what are we looking at there? My glasses can't pick it up. I'm sorry.
International Political Economy. It was
That's it. Thank you. Thank you. Susan
Intellectual
Strange.
History by Benjamin Cohen.
Benjamin Cohen. Okay, Susan Strange would have been another one to have there. Absolutely.
Okay,
Completely
absolutely
agree.
right. So yes, okay.
Yeah. But no one's talking about this, but it changes everything, because as I keep saying in my Global Daily, which I write 3 days a week, if you understand this, and then you put that whole commodity complex argument alongside it, where people are saying, okay, this is our response to that block-based mechanism. We're going to set up a different block. We're going to bankrupt you because you're only based on finance, which we are to a degree. You can't go back to a zero interest rate policy, but I can't tell you how many people are out there saying, so when rates go down and assets go up, so when rates go down and assets go up, it's like, let's presume they don't, and they go cross-eyed and just go back to type again. They don't understand that we may be in a very different geopolitical world now, which changes everything in terms of asset valuation.
Richard, I got nothing. I'm waiting for you.
Oh, yeah. I mean, and with that thought, though, do you think there are any constraints on the other side of the equation? With 6% interest rates in terms of the effects on debt servicing, right? The cost of debt servicing. Could that be a constraint up at those levels?
Yes and no. Okay, and here we come to something which is a really radical idea, which I can say I've raised in the highest forums, because last year out of the blue I got asked to actually present to the G20 financial working group, which is the secretariat one level below the actual finance ministers and treasury secretaries and central bankers who put together the position paper for them. And completely out of the blue, I was asked to present to them. And what I said to them is, you're stuck in a position where whatever you do doesn't work. That's since been picked up in the market as a Zugzwang, the chess move where you can't move. Ironically, without actually being familiar with that, because I'm not a very good chess player, I had actually put together a presentation showing that whatever you do on a chessboard, it doesn't work. About debt, because I had a chessboard, because when you put the grains of rice on, you go 1, 2, 4, 8, 16, 32, and by the time you get to the end of the chessboard, there isn't enough rice in the universe to fill it, okay, because of exponential growth, which is the way that debt works. So that's how I was using the chessboard. But I said to them, you're going to have to raise rates. You're going to have to keep raising rates. But that won't work in a geopolitical struggle where the other side is going to keep rates low and can keep producing weaponry, and you can't, because then you've got a holier than thou view on debt, and you've lost the physical game on the board. So what do you have to have? High rates and low rates. Very high rates and very low rates. And in a nutshell, you're going to have, let's say, a 5.25, 5.5, let's say 6% Fed funds rate for everyone doing absolutely useless things involving acronyms. Who needs CDOs? Who needs CDOs squared? Who needs a whole welter of financial asset-based terms, which when you actually ask the person involved, when you strip away the layers, what's at the base of this? Are you producing something that's good for USA Inc. or the West Inc. or not? And if the answer is not, we don't need it. Let that blow up. Let it go. Let shadow banking wither and die. But what we will need is free money, and I think it will be almost QE style, as in here we go. Here's a 0% interest rate for the Pentagon. Or the military industrial defense complex. So the simple bullet point I keep repeating in my Global Daily is we're going to have higher for longer plus acronyms, because the acronyms will vary. Like in Europe, for example, it's unlikely to be QE. It could be something there they call TLTROs. Such a long name, I can't even remember the bloody phrase behind it. But basically, it's coordinated bank loans.
Operations.
Thank you very much. I don't actually cover the European markets. We have a team of experts who do, and they do a great job. I'm just a big picture guy. But the point being, if we've got very high rates plus free money for the Pentagons or infrastructure or supply chains, that looks to me, A, what we'll need to do, and B, Ira, I'm sure you'll remember this, and I love talking to people who have been there, done that. That's how the world used to work before the Big Bang reforms in the 1980s, when we had credit rationing, where we had hypothecated credit, where we had, this is the year where we need agriculture to do well, so you get cheap lending. We don't need industry so much this year, so you're going to have expensive lending. You can't have one benchmark rate. And you can't have one benchmark rate globally where capital can go wherever it wants and fight a war, which is what we're doing economically and what we're talking about doing physically. Don't work, can't work, won't work.
Wow, interesting your thoughts, Ira.
Hey, Richard, that was the exact question I would have asked, because the United States is going into this shift, and it's a shift away from the neoliberal model that has driven the world, especially, I would say, since Reagan for sure, and then certainly since the fall of the wall, the Berlin Wall, and Deng coming into power in 1979, 1978 in China. So we have certainly been on this path, but we have, and as I tell people, when every time people run wild with, well, Jerome Powell is finding his inner Volcker, I go, no, he can't find his inner Volcker, because Volcker faced a GDP to debt ratio of 39%. We're at ridiculous levels plus private sector debt. So if he finds his inner Volcker, the world will be placed into a deflationary spiral. Now, Michael might think that's where we have to go. And we might. And I'm not, I know that people like David Rosenberg and Lacey Hunt are in that camp, that we're going to get there, that things will collapse. I'm not going to say collapse, because they don't say that, but that's the way I would view it. In order to get down to those types of interest rates again, you would have to have a deflationary spiral in a heavily debt-laden world. And that's what fares me. So I'm not disagreeing with you, Michael. I think, and this binary thing, it drives me crazy, because it's either pivot or pause. Pivot or raise.
Yeah.
You can be on pause, and I think that's right, for the next 18 months. Okay, we have rates here. We're going to see where this goes. We're going to do some more quantitative tightening. We're a little bit worried about the assets on bank balance sheets, and we haven't even gotten to say the shadow banking system with the questionable debt that they're carrying loads of. So the world is a difficult place, and you say that we'll funnel money to where it needs. Now, under a new industrial policy orientation, you could do that far more effectively. In today's world, no. So there's going to have to be some genuine pain that has to be imparted to the players. Yes. And interestingly, what we're undoing is what Thomas Piketty told us in 2011, right?
Yes.
R is greater than G. Well, we're gonna reverse that.
Absolutely right. And I think we are. And I agree with everything you've said. When people tell me, rates are going back down again, so therefore buy assets, it's like, no, if rates go all the way back down, we're in a 2008 where we can't reflate our way out of it, because, there's question marks over the central bank credibility now and central government credibility. So we're really in shtuch if that happens. It's in a serious way, right? I hope we don't get there. But I suspect, as I was alluding to a second ago, or more than alluding, shouting about, that the only way we can do that is, I do genuinely think you make an argument that pain needs to be gone through for sectors that are no longer relevant. For example, if you look, I don't want to name names, but if you look at certain large US financial institutions, which are getting much bigger at the moment, I think that they could be systematically important in terms of imparting messages to a smaller number of regional banks, which are credit conduits to the real economy, that from now on, for example, we don't want to be financing office centers. We want to be financing warehouses. We don't want to be financing, shops. We want to be financing factories. So that message can be channeled with some pain, as the French say, pour encourager l'autre, basically to encourage the others. So you have a few failures, a few consolidations, and and we've seen. I think I can name some names. Blackstone was in the FT. BlackRock was on the FT the other day, saying, we might be lending money now as a conduit to smaller banks. That couldn't be any more USA Inc. if it wanted to. And so I can certainly see that this wrenching relatively wrenching turnaround in the supertanker would go via this particular path. It still looks like the USA of old, but it operates in a very different manner. Is there money to be made doing that? You bet your bottom dollar there is. There is good money, good opportunities, great profitability. But the key point is it doesn't lie anymore in Wall Street making money from money uselessly based on consumer bubbles and just empty asset prices. It's going to be a much more Chinese looking system, which I emphasize again is a Hamiltonian American system. You know, wearing a Chinese overcoat that will actually put some muscle back on the military industrial complex, which is what the US needs to remain number one from a military perspective. And as I tell everyone over and over again, have done for years, if you're not number one from a military perspective, you're not number one from an economic perspective for very long. It doesn't last. You need to have both. And you know, you tell economists that again, they go cross-eyed again, because that means, oh my God, I've got to start reading strategic studies. I've got to start understanding what defense ministries are doing. I don't want to do that. I don't need to understand interest rates or inflation. Don't give me other things to talk about that I don't understand. It's far too complicated. But that's what you need to do, guys. That's called the big picture of history. I'm sorry if it's more homework for you and you can't sell, you can't sell nonsense to retail punters as easily as you used to. But if you actually want to understand things, that's what you got to do.
I'm sitting here really, I'm laughing because I can bet if I pull off Giovanni Arrighi off my bookshelf or some Fernand Braudel, I think we'd be very comfortable. I mean, I'm enjoying this. This is like I was back in Madison, Wisconsin, when I was working in graduate school, having these discussions, but not at such a high level because I had no practical experience. I had a lot of theoretical knowledge that I surely didn't know what to do with. But I think that point is so well taken because there is going to be a dynamic shift, and with that shift is going to come pain. Now, the pain is going to be who gets displaced?
Yeah,
I don't know. But now I'm glad you told me about your involvement with the G20, because this morning I spent an hour reading the 40 pages of the G7 communique.
Yeah.
I wanted to put a gun to my head because I go, this is like a bad college term paper in which it may have been written by Chat GPT because it just filled it with everything. But I'm searching for, that's what I keep searching for. I know it's in there. There is one line about currency valuations in the 40 pages. One line, reasserting basically what they decided and put out in 2016 or 2017, and they've reiterated it over and over again, which is you're not supposed to utilize your currency to gain a trade advantage over basically, members of the, so there's one line in there. And yet I'm looking at the board and I'm looking at the euro yen, dollar yen. I could care really very little about at this point in time, but the Germans are getting their proverbial asses kicked because the euro yen is up at 150, which is at multi-year highs. They do it through the good offices of the BOJ, chaired on by the MOF, to keep the yen weak because they see that transition. And finally, the Nikkei, the Japanese equity markets, have woken up to the fact that Japanese corporations are making money hand over fist because the weak yen has promoted and a new onshoring on top of that. And to pick up your point on the military industrial complex, you are now going to have Japan competing in the military hardware business because they're very good at re-engineering products to a much higher level, hence Japanese cars, Japanese tool works, Japanese optics, we can go on and on and on. The Japanese miracle was pretty easy to see, which the Chinese are trying to duplicate, but are lagging terribly behind because at least Japan operated, they had the Keiretsus, which directed a lot of it through the Ministry of Finance, but they were still capitalist based in a capitalist world battling with the evil Soviet Empire. But all of these things are in place, and the United States and others, especially Western Europe, is going to have to wake up and go, we got a terrible, we've put ourselves in a terribly non-competitive position.
I've got so many things I want to just
Go ahead. I'm sorry,
jump in on that.
Richard, we're stepping
No,
on.
No, that's very good. Yeah. Go ahead. Yeah.
if I may, the first one is this, Ira. I love your analogy about, I love what you're saying about Japan and the US. You're absolutely right. The only nuance I would add to that is I don't think they're competing, they're collaborating. And I expect the F-35s to have those nice kind of heated toilet seats added to them fairly soon. So you're going to get like Japanese quality toilets and F-35s. But I'm being facetious, but the synergies there are fantastic, absolutely. And Japan is effectively decided to be bolted onto the US economy, which is a win-win for both, absolutely. And I am optimistic on Japan. I am, for the first time in a long time. Europe, I completely agree. I'm not. I won't go into any more detail, but I'm not. They're not getting the modern world in the way that the rest are. Anything nonsense in the G7 was probably partly a reflection of the fact they had to water it all down for Germany, who still think, that we're living in a land full of magical chocolate coffee pots and teapots, which of course melt as soon as they hold anything. They're completely useless. But your broader point about the G7, Ira, I think what we are both saying, and I'm being pretty overt in saying it, is we're dealing with a secretariat generally, globally, across the financial industry, across finance industries, across bureaucracies, which are not fit for purpose. They've been underfunded for a very long time, overly politicized in not very helpful directions. And what they understand about economics is purely neoliberal. It's just died into the water or died into the system. They don't actually know how to think in this new realpolitik environment. I can name a number of leading bureaucrats in the US, for example, one or two in Europe who get it and are trying to change the conversation. But you're going to have to change everyone below you. Otherwise, you give them their orders and they just go home and do exactly the same thing because that's what they think they should be doing. Now, where you are starting to see change come, I have to say, is ironically from Europe in one respect. You spoke about Jake Sullivan's speech, and it is very important. But it was actually a follow-up to another speech given by Christine Lagarde, the president of the European Central Bank, which was given just around a week before that. And when Lagarde gave that speech, everybody, including all my European colleagues and friends, they're like, oh my God, she's been reading you, Mike. She's been reading you, Mike, and she's actually responding to you. What Lagarde said at the Atlantic Council in New York, and I advise you to Google it and read it. It's called "In a Central Banking in a Fragmenting World" at the Atlantic Council. She basically said, in a nutshell,
I read it.
The world is splitting into geopolitical blocks. So let's have none of this. Is it? No, it isn't. We're not sure. It is. It has profound implications for central banks. It's very inflationary, she said, because fragmenting supply chains will be, because no one can be as cheap as China was, and replicating it. So in other words, friendshoring or onshoring or nearshoring will always be more expensive for many different reasons, not just production costs, but then seeing higher wages, which means people have more money to spend, which is inflationary, second and third order, etc. We have got fragmentation of invoicing of currency and an attempt to basically carve out a subsystem within the global system, which China and Russia are trying to do. And they can succeed in doing that upstream, by the way. And then you have upstream pricing in one currency and downstream in another. That don't work. So downstream would eventually shift to the upstream. That fragments the world, just like we saw in the 1930s. She made that absolutely clear. And then, having said that inflation is going to be higher, we are fragmenting. People are trying to get different payment systems. Even if it's not global, it will work in a block. She said central banks need to learn the lesson of the 70s. Higher for longer. We ain't coming down. We need to be offering swap lines to economies that can't get hold of our currencies. So, for example, you've got an emerging market who can't get dollars right now because dollars are expensive because it's 5.25%, and they want to do trade financing in dollars, but they can't get them. Let me tell you, that is happening on a daily basis. The Fed needs to be giving swap lines to emerging markets who are their friends. Guess what? We aren't doing it. We're only giving it to developed countries to speculate in shadow banking. I don't know how much longer for, but that's what we're giving them for. And punchline, she said, central banks need to shake hands with finance ministers to support spending into the supply side. Guess what? That's armaments. That's factories. That's infrastructure. She said it in black and white. We need to cooperate with the fiscal authorities, not they spend, we hike rates. So you get a tax cut for consumers, rates are going up. Rates are going up and staying up anyway. But she openly implied, and everyone's now scrambling to work out how this can be done. That's the next discussion. If you come to me and say, I'm going to build an infrastructure here, which helps decouple from China, either in my country or in that country, or we're going to set up alternative supply chains to make, in the long run, inflation lower, because we've got more physical supply in the long run, you'll find a central bank that will help fund it. That's my bloody argument, guys. That's what I was saying. Christine Lagarde said it. So Sullivan is saying it. Lagarde is saying it. I mean, I'm not dropping the microphone because we don't know how.
Right.
But the what is already being agreed. And Lagarde couldn't have said that without tipping the Fed. There's no way that didn't go through all the layers of national gatekeepers, and she didn't tell Powell, by the way, I'm going to come to New York and give this speech. Of course, Powell knew she was going to say it. But if Powell had given that speech himself, everyone would be saying war economy. So he couldn't give it. Sullivan could give it. That's my thought.
Go ahead, Ira. Yeah.
Well,
Wow.
it's so, but, and I'll, because I follow Europe, because Europe is such an important part, and I can see that you do too. Lagarde needs a Euro bond. She needs to end the fragmentation of those debts in order to get this done, because you're going to, you need a harmonized fiscal situation.
Well, ideally, yes. But again, when I speak to my Euro experts, who, trust me, they know Europe. They're very, very good. We had a very good and very interesting detailed discussion recently, which I can't reveal much of.
No.
What I can tell you is when we were going through the nuts and bolts of, look, if Lagarde needed to do this, let's say the excrement hits the fan and the ECB needs to act in a week, what mechanism can they use given they don't have what you're describing? And they said TLTROs. All the framework is already there right now to basically tell commercial banks in Europe, here's how you'll make your money, doing exactly what we're telling you to 3 decimal places. You don't have to, but you'll make zero money doing anything else. You will make your money lending to this company, specifically in this sector, to produce that for us, sold to them. And it's ready to roll.
Interestingly, because I thought that the US, the acronym that they set up to do the bond purchases for the FDIC out of Silicon Valley and Signature was actually, and I said it to several people, I said, that's actually a TLTRO because they're extending money for a year. The targeted long-term repo operations.
BTFPs you're talking about?
Yeah, essentially the same thing. Where, yeah, give us your debt on your books. We'll give you the funding, and there's no redeeming for this for a year. Well, and that's what they've just extended it. They keep saying that they're going to end it. Well, Lagarde is very careful within Europe because the one thing she cannot take, which is why their QT is so minimus, they cannot take fragmentation of the bond market. I mean, she has said it over and over and over again. And actually Wolfgang Schweibel, of all people, at the beginning or a year into COVID, wrote that piece in the FT, May of 21, I believe it was, in which he thought the PEP program should be grants and not loans, because as he said, which blew my mind, I mean, there's no harder money person than Wolfgang Schweibel, who is in a policy-making position. And he said, giving them loans is like putting stones in their pocket, whereas if you give them grants, it's giving them bread. I said, well, here's an opening to actually get to some type of fiscal. If Wolfgang Schweibel, who was, I think he was still finance minister at the time in Merkel's administration, if he was willing to say that openly, I think they missed a great moment, because they do have to come to terms with this, as they would call it, their Hamiltonian moment, going back to it, where you can consolidate. They need to consolidate these bond markets. Otherwise, they're going to have to keep then running into the German High Court in Karlsruhe, and those who are in Germany who are opposed to any more Europeanization of the German economy will keep running to the court. They need to get this solidified, and they need to do it now, because I think you're right. When, I didn't read, when I read the Lagarde speech from the Atlantic Council, I didn't take it. And now I'm thinking about it. Now I'm going to go back and reread it, because I do read their stuff.
Maybe I'm seeing things that aren't there because I want to see them, and that's always a problem we can all have. But I genuinely think, independently, people around me who listen to me agree half, but not the whole way. They were contacting me and saying, "Geez, Louise, Lagarde is basically opening the door to everything that you've been saying, which is differential interest rates,
Yeah.
free money for you, expensive money for you, by sector, focused on supply chains, focused on national security, focused on decoupling, which is, the global
Yeah.
zeitgeist."
And then she had to run into Macron, which for the life of me, he got quiet very quickly after his.
Well, he wants the same thing. I mean, the only difference really is effectively that Lagarde understands how the euro dollar works. So she's not talking about, tweaking America's nose. She's talking about working with the Fed to basically build up a cross-Atlantic supply chain.
Yeah.
Macron's talking about Europe saying, "Thank you very much, America. We're going to go our own way. You have white bread, we have croissant," and doing something completely unique. That's never going to happen. Europe is not in a strategic position because of the euro dollar alone, let alone US LNG, to turn around and say, we can be strategically autonomous. It's a joke to imagine it is. But they can certainly be much more proactive than they have been. But I think the scenario I need to make clear is that I don't expect Europe to be pushing ahead with what you said they need to do, and everyone agrees needs to be done, until there's another crisis. But if you get another Ukraine, if you get Iran and Israel kicking off in the Middle East, and suddenly no energy is flowing to Europe through the Straits of Hormuz or through the Suez Canal, if you get China blockading Taiwan 12 months from now after the next Taiwanese presidential election, these are just hypotheticals, right?
Yeah.
Europe's going to wake up and suddenly realize we can have all the purist hard money views in the world that we want. It isn't going to put gas in our pipes, food on our table, or bullets in our guns, and things will change overnight.
No, 100% right. So then you start to wonder, why is Germany not turning back on the nuclear reactors for the short period through that anyway? Oh, I know, that would be too good a policy.
That would be too good a policy. That's it. It's not allowed. Yeah.
And then you have Macron, who from the day he got into office, when I was blogging very actively, and I kept talking about he believes just because he's sleeping with de Gaulle's third wife doesn't make him de Gaulle. But that's my terrible sense of humor, as I put on my funny head. So that's my feelings about Macron.
Just a final question, if okay, on Michael. You're given this vision and the trends we've discussed. How does the U.S. dollar and the reserve status play out? Like, what do you make of the de-dollarization talk? Is it a real trend?
Great question. Really quick answer. It is a real trend, but not in the way that people think. Nothing can replace the dollar the way the dollar operates as the foundation for a global system. That doesn't mean that China, Russia, Iran, et al. Couldn't get together and try and build a dungeon under the castle. They'll never capture that castle. They'll never replace that castle. They can build their own dungeon complex under the castle where they can live very, very happily. And it will undermine the foundations of the castle. It won't be as big or as grand as it was. And most European castles have largely crumbled away inside, right? So that is a long-term threat. But if you're asking specifically in terms of, is the dollar going to suddenly dump? No. Am I bullish or bearish the dollar? Long-term dollar bull. For the simple fact of the matter that everyone's in a mess, including America. And as I hope I've made abundantly clear, I expected rates to go up. I was saying higher for longer when it was a sarcastic comment to all the people who were still saying lower for longer. Everyone's saying it now. My title of the 2023 outlook at the beginning of this year was the pause that doesn't refresh. Okay. And that's exactly what I think we've got. We've got a pause which won't refresh because it will be more rate hikes on the other side of it, quite probably, even with bank restructuring going on. And if you're going to say 525, 55, 575, 6% US dollar, good luck in shadow banking, holding a highly leveraged cargo ship full of oil or
Mhm.
iron ore or grain, which is depreciating in price, and sitting there and saying, yeah, that's what I'm going to bank my savings on, rather than something in the bank earning me 6% risk-free unless I'm geopolitically naughty. So
Mhm.
I'm still a bull on the dollar,
Mhm.
fully understand the problems, not naive to them, but everyone else's are worse.
Mhm. Wow, interesting. And Ira, your thoughts on that?
Yeah, this is like such a good way to I think end this discussion. Now, I have a very good friend who I discuss this with over and over. We were talking about it this morning, especially in reference to Jake Sullivan's speech, because Niall Ferguson has written a piece citing that just came out. It was on Bloomberg, I guess, over the weekend, talking about that Jake Sullivan's speech was related to George Kennan's work. And I haven't read it yet, so I can't, but my friend Kevin McCarthy, not the Speaker of the House, for all the idiots who write to me and go, you need new friends. There are more than one Kevin McCarthy in the world. So we're discussing it, but if that's the case, and I haven't read the Ferguson piece, will the United States, if we go to a new, and I know who you're citing because we've done a really great podcast with Zoltan Pozar. So we know, I know, and I have great respect for Zoltan.
I've never met him, by the way. He seems a very nice guy. He's worked with colleagues of mine. I like his work a lot. It's
Yeah.
stimulating and interesting. But I have to say, Zero Hedge, the
Yeah,
financial.
no,
They tweeted a while ago, Michael Every so hates Zoltan Pozar. It's like, no, I
Oh,
don't
no.
think he understands that you can just raise rates to deal with this. But anyway, sorry, I don't mean to interrupt.
and even Pozar's last speech, when he finally reappeared, he's been disappeared for a while. He kind of went underground, but he gave a talk at a Fed, or he made comments at a Fed meeting 2 weeks ago, I think. I still have the piece, in which he talked about higher for longer rates, by the way.
See there. And that changes it. But you try doing that, and then suddenly the commodity complex doesn't look so clever. I mean, yeah, there is, as you said, there's pain for everybody. But I think having fiat is a lot more handier than having commodities, given you can expand it into areas where you can then produce commodities. Fiat only doesn't work if you have no commodities at all whatsoever. If you're starting from nothing, like if you're like a desert of a country with nothing at all, and you say, well, don't worry, I've got my own fiat currency, so I'm going to be like Singapore and China tomorrow. No, you're not.
Yeah, right.
Yeah. But if you got stuff, you can get stuff.
Let me see if I can find. Oh, here. This was, and I can give you the date of the article. I do have it. It was from May 5th, and the title of the article: Pozar says Fed won't let anything get in the way of an inflation fight. And it kind of threw me, because when I read it, I had to read it 3 times because it wasn't where Pozar typically was. And I'm glad you brought up Zero Hedge, because I have no time for them. He's been around when he first started. I figured they were pretty bright, but not. I call them the National Enquirer of the financial news, because if he can't make a sensational headline, he's got no time for it. But in all of this, I mean, it gets very interesting. But if we pick up the Ferguson citing George Kennan, then you really need to, what Zoltan has talked about from a different perspective, Bretton Woods 3. But this Bretton Woods 3 would be in your vein, because with the higher interest rates, the dollar would have to be artificially stronger. And I haven't been there, so I have to think about this very deeply. The dollar would have to be stronger in order for the United States, again, to levitate everybody else who wants to come into this new industrial camp.
Indeed. Well, I mean, very briefly on that, because apologies, Richard, but this is such a fascinating area. I think we have to unpack it just a little bit more. I mean, if you look at the trend in Sullivan's speech and in terms of the intellectual direction, again, which was completely consistent with all the earlier intellectual references that we were making. Once you start understanding them and you go down the path, you can see where we end up. Part of that is going to be tariffs, which I was predicting long before Trump, which, a dollar positive, not dollar negative. And the other part is capital controls. You're already on the verge of an inverse CFIUS to stop money going out into China. That will happen from the US. That was always logical. First goods, then capital. That's the way it would have to go. So if you actually start saying we're going to limit where FDI and capital flows go out cross block, which is going to happen, And, and then you start having internal capital controls, like money needs to go here, not here, which is the differential interest rates. And then you also start saying logically, we don't want money coming in, which is a Pettis argument. We don't want Chinese money coming into treasuries, therefore you don't run a trade deficit with China, because the trade deficit is your capital account surplus. China isn't going to sell to you if they can't park the money in treasuries. You actually strengthen the dollar by doing that. You don't weaken it. So you're decoupling with a stronger dollar while bringing in other economies like Japan, and many, many others, and bolting them into your new complex of F-35s with heated toilet seats. And I think it's a very, very, very powerful complex. And it also keeps commodity prices relatively low, which is good for the inflation fight. So I know it's a head spinner, and many people don't see this, and they're still in the weak dollar camp. And you could go down quite a bit on if the Fed start pivoting, yeah, bad news for the dollar. But if they stick to what you're implying, what I'm implying, I think we may have a floor now, and I think everyone else will find they can't be as hawkish as the Fed.
So I can only say this, Richard, what you've set out to do with Financial Repression Authority, which is to get people to think about these things. This is the most thoughtful. I don't know that, and you have to give Michael credit. He said there's no investable ideas per se to begin with, but there's a lot here because there's going to be a lot of upheaval. And where are the investable opportunities going to be amongst that upheaval? But that's another podcast.
Yeah.
A whole nother podcast. Yeah.
Yeah.
Exactly.
No.
Okay. Yeah. Oh yeah, this has been a fascinating discussion. I mean, lots of food for thought, just bringing everything together, geopolitical risk into the economic realm. How can our listeners and viewers learn more about your work, Michael?
Well, I think the easiest way for now is if you look for me on LinkedIn. It's Facebook without the pictures of cats that look like Hitler. But if you go there, you'll see my Global Daily appears fairly frequently. I do write bigger thematic pieces from time to time, but they are more generally for Rabobank clients. So reach out if you fall into that particular category. And I'm a pretty regular appearer, in these kind of media, and also at conferences. So keep an eye out where I'm speaking near you, and hopefully we can have a conversation at some point.
Great. And Ira?
Well, I'm going to retire now because I know it's all in good hands, so I'm out of here. No, I haven't really been blogging, but I've been doing, as I say, Richard, these podcasts. And this is now, wow, this sets the table for so much as we go forward here. Yes,
exactly.
I mean, and Michael was very honest about it. This covers energy, agricultural, and how is this new industrial policy is laid out by, which some people, if you're a friend, would want to call it a Biden doctrine. I'm not sure we're there yet, but it is certainly in play now. I'm going to have to go read the Ferguson piece and tying it to Kennan. And I'm so comfortable here because I'm sure Michael and I could sit here and, I could pick out annotated books right off my bookshelf right now. I still come back to Burdell. I still come back to Arrighi. I still come back to Wallerstein because they're all people who think, as you say, outside that MBA mindset.
Yeah.
And really bother to dig deep to see what the structural possibilities are. And I think that's critical. And it's not pause, as long as I make jokes about Macron and sleeping with de Gaulle's wife, it doesn't make him Charles de Gaulle, even though he doesn't do that, of course. But it's interesting that everybody's thinking now, we've gone from non-binary via gender to binary in all our economic and political discussions. It's either a pivot or a raise. Well, it's not quite that simple. And I think when you go that binary route, you get yourself in trouble because you simplify things that are far more complicated.
Great. Thank you so much, Michael and Ira. Thank you so much for the discussion. Thank you.
This was great. Thank you. This was
my pleasure.
This was an absolute pleasure. I'm glad you made this possible, and hopefully we'll have some more communication.
Oh, Hope so. I hope we do get to do it again.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.